So what happens when a company's brand new factory suddenly isn't worth what it used to be? Or, when they sell off an old piece of equipment? It's actually not as simple as you'd think. Today, we're going to dig into the super important accounting rules behind asset impairment and disposal.
And this question, it really gets to the core of everything. You see, a company's balance sheet is supposed to be an honest snapshot of its value. But sometimes the numbers on the page are telling a story that's totally disconnected from reality. An asset could be listed at a super high price, but in the real world, its value has completely tanked. And that is a huge red flag for anyone looking at that company.
Right, and that's exactly why accountants have strict rules for this stuff. They're designed to stop companies from hiding these big drops in value. It's all about forcing them to be transparent and making sure their financial statements show what's actually going on with the business.
This brings us to the main idea here, impairment. Basically, an asset is officially considered impaired when its value on the balance sheet is way higher than the money it can ever hope to earn back. And look, companies can't just sweep this under the rug. They're required to test for impairment whenever there are clear warning signs, things like the asset's market price suddenly dropping, or a big negative change in how it's being used. Okay, so how do accountants actually figure this out? Well, for most assets that have a limited lifespan, we're talking about things like machinery, buildings, or patents, they use a very specific two-step impairment test. You can kind of think of it like a detailed financial health checkup for that asset. All right, first up, we have what's called the recoverability test. This asks one really simple question. Is this asset going to generate enough cash in the future to cover the value it has on the books right now? If the answer is no, then we have a problem, and we move on to step 2, figuring out how big the financial loss actually is.
Let's look at a real-world example to see how this works. Imagine a company has a machine with a book value of $160,000. But management is seeing that demand for its product is just cratering, so they estimate the machine will only bring in $150,000 in cash for the rest of its life. And that projection right there, that's a classic trigger to start an impairment test.
And this is it, the moment of truth. The carrying amount, $160,000, is greater than the future cash it's going to make, $150,000. So the asset has failed the recoverability test. It is officially impaired, and now the company has to, they are required to, recognize a loss.
All right, on to step 2, measuring that loss. Now, you might think the loss is just that $10,000 difference from the cash flow test, right? Nope. The actual impairment loss is the difference between the carrying amount of $160,000 and the asset's current fair value, what it's worth on the market today, which in this case is $136,000. That gives us a $24,000 impairment loss, which hits the company's income statement directly.
And this is super important. Once a company writes down an asset like this, there's no going back. Under U.S. accounting rules, what we call GAAP, this loss is permanent. It doesn't matter if the asset's value magically recovers later on, that loss is locked in. The new, lower value becomes its permanent floor, which will also affect how it's depreciated in the future.
Okay, so everything we've talked about so far is for assets that, wear out over time. But what about the ones that could theoretically last forever, like a company's famous brand name, or something called goodwill that you get from buying another company? For these, the rules are a bit different, and actually, a little simpler.
Yeah, for these indefinite life assets, you can just throw that entire first step, the recoverability test, right out the window. You jump straight to just comparing the asset's book value to its current fair value. It's a much more direct, one-step deal.
And with something like goodwill, companies have to do this test at least once a year. The process is pretty straightforward. You just ask, is the carrying amount greater than the fair value? If the answer is yes, boom, that difference is your impairment loss. It's a much simpler calculation, but it is no less important. Okay, so that's what happens when an asset loses value while you own it. But what about when a company just decides to sell it off? This is called disposal, and it can really only go one of two ways. You either make some money or you lose some money. So let's say a company has this machine on their books, valued at an even $100,000. They decide it's time to sell. And what happens next all comes down to one thing: how much cash they can get for it. So, best case scenario, they sell it for $135,000. The difference between what they sold it for and what it was on the books for is $35,000. That's a $35,000 gain on the sale, and that goes straight to boosting the company's income. But what if the market's not so great? They only managed to sell it for $90,000. Well, that's $10,000 less than its value on the books. So now they have to record a $10,000 loss on that disposal.
Okay, let's do a quick gut check on a really important point we covered. When does a company have to test a long-lived asset, like a building or a machine, for impairment? Is it A, annually, B, periodically, or C, whenever events indicate its value might not be recoverable?
And the answer is C. This is a really critical distinction to understand. Unlike goodwill, which has that mandatory annual checkup, for most of these big fixed assets, the test is event-driven. A company can't just look the other way when there's bad news. If there's a sign that an asset's value has dropped, they're required by the rules to test it.
So, we've walked through all the how-tos of impairment and disposal. But let's take a step back and talk about the why. I mean, why do all these complicated rules even exist in the first place?
You know, it really all comes down to one thing: financial honesty. The whole point of these rules is to stop companies from carrying assets at inflated, totally unrealistic values. It forces a dose of reality into their financial statements, which gives investors, employees, and all of us a much more accurate picture of what a company is truly worth.
But, and this is a big but, there's a catch. Things like future cash flows and fair value aren't exact sciences. They're based on management's own estimates and judgments. They're educated guesses. So while these rules get the numbers closer to reality, a lot of it still depends on human assumptions. And that leaves us with a really important question to think about. Just how reliable are those estimates? And what does that uncertainty mean for you?